At least two accounts are affected.
Section A. Accounts and the ledger.
People keep accounts in many different forms, both in computers and on paper. Next, we'll talk about the way the information gets into the accounting system. All the accounts are entered and organized in what's called a ledger.
The ledger is the formal name for the books, or book of accounts.
Now let's talk about the way information gets into the accounting system, okay? You start. No. Okay, I'll start. Earlier we introduced the 5 major account types. Now let's talk about how they're used in the ledger. You guys are a real bright bunch, aren't you?
As we discussed earlier, most accounts may be classified into one of these 5 major account types. These account types are shown as T accounts because they look like capital T's. These are the super accounts we discussed earlier.
The T account is shaped like a T. It is used to determine a balance of a particular account. The T account has 2 sides. The left side of the T account is called the debit side, abbreviated DR, and the right side is called the credit side, abbreviated CR.
The account balance is the difference between total debits and total credits.
If the total of debits is larger than the total of credits, then the account is said to have a debit balance. If the total of credits exceeds the total of debits, then the account is said to have a credit balance.
People studying accounting often confuse the meaning of the words debit and credit. In accounting, debit means left and credit means right.
Debits and credits are simply accounting tools that are used to increase and decrease balances in accounts. The effect a debit or credit has on a particular account depends upon the type of account you are talking about. In other words, the effect a debit or credit has depends on which of the 5 account types you are dealing with.
I'm Super Accountant, and I will help you with your super accounts. I will go through each of the super accounts and tell you whether a debit is an increase or a decrease, and whether a credit is an increase or a decrease. The reasons for this will make more sense as we work through examples. Just remember, left means debit, right means credit.
Thank you, accounting man.
That's Super Accountant.
Super accountant.
It's okay, I'm not offended. I will use T accounts to illustrate how debits and credits work in accounting. It is vital to your safety as an accounting student to understand the following about how debits and credits work.
When you want to increase an asset account, debit it. If you want to decrease an asset account, credit it. This is shown on the screen as a plus or a minus.
It's exactly the opposite for liability and owner's equity T accounts. To increase a liability account or an owner's equity account, credit it. To decrease a liability or owner's equity account, debit it. This can again be seen with the plus and the minus on the screen representing an increase and decrease. Now I want to discuss the 2 remaining account types, revenues and expenses.
I think I can take it from here.
Then carry on, my little accounting buddy.
We said earlier that revenues increase owner's equity and expenses decrease owner's equity. This is true, but it is also important to understand how revenues and expenses themselves are affected by debits and credits.
Wait, somebody's in trouble. They're adding wrong.
Revenue accounts are increased by crediting them and decreased by debiting them because an increase in business revenue increases owner's equity.
Expense accounts are increased by debiting them and are decreased by crediting them because an increase in business expenses decreases owner's equity.
Now let's talk about how debits and credits are used to record transactions in the accounting system. Transactions are first recorded in the accounting system in what is called a general journal.
Section B.
To watch more free educational videos, visit our website, studioforlearning.tv. Stretch your brain online.